Have you ever received a letter from the IRS that made your stomach drop? For most disabled veterans, that feeling is compounded by confusion because the core of their compensation, VA disability payments, is supposed to be tax-free. It's a foundational promise, a benefit earned through sacrifice, shielded from the taxman's reach. But lately, something has shifted. A growing number of veterans who rely on these non-taxable benefits are finding themselves under intense scrutiny, receiving audit notices, and facing difficult questions about their finances. The IRS is suddenly watching disabled veterans more closely than ever before, and it's not because they've changed the tax code on VA compensation. It's because of a complex confluence of modern data technology, targeted enforcement efforts, and a disturbing rise in exploitation. This isn't about punishing veterans. It's about catching the anomalies, the discrepancies, and the outright fraud that is hiding within this protected population. We need to understand exactly what is happening behind the scenes in Washington, D.C., and how your financial choices might inadvertently be raising a massive red flag. We're going to break down the 7 critical reasons the IRS is focusing its powerful lens on disabled veterans right now, and how you can protect yourself from becoming an unintended target. The first and arguably most significant catalyst for this increased scrutiny is the rise of VA disability scams and unscrupulous facilitators. For years, the process of applying for or increasing VA disability benefits was complex but straightforward, typically involving VSOs or accredited agents. Now, we've seen an explosion of third-party companies, often referred to as claim sharks, promising guaranteed increases in ratings. They advertise heavily, using sophisticated marketing to target veterans struggling with the bureaucracy. These companies operate on a contingency basis, often demanding large percentages, sometimes 5 to 10 times the monthly increase, as their fee. Here is the critical pivot point that draws the IRS in: the fees themselves. Because these companies are not accredited, they often structure their payments as consulting fees, coaching fees, or educational services to skirt federal regulations that prohibit contingency fees for VA claims. When a veteran pays thousands or even tens of thousands of dollars to one of these firms, that payment creates a paper trail. The firm receiving that money is reporting it as taxable business income on their end. They have to, or they face their own massive audit. But the IRS is sophisticated enough to cross-reference that reported income against the veteran paying the fee. If the veteran is paying a $15,000 coaching fee but is reporting minimal or zero taxable income, relying solely on their tax-free VA benefits, that transaction immediately creates a high-risk profile. The IRS algorithms flag the veteran not necessarily for the VA benefit itself, but for the unreported income that might have been used to pay the massive fee or the underlying financial activity that allowed for such a large, unscheduled expenditure. Furthermore, the IRS views these facilitators as part of a high-risk compliance group. When the IRS successfully audits one of these firms and discovers widespread non-compliance or fraudulent activity, such as advising veterans to inflate claims or fabricating medical evidence, the entire client list of that firm becomes a prime target for downstream audits. This creates a ripple effect where thousands of veterans, many of whom were simply seeking legitimate help but fell into the wrong hands, are now facing detailed reviews of their personal finances. The IRS is essentially conducting a massive systemic cleanup operation, and unfortunately, the veterans who used these services are caught in the dragnet. This deep dive into the business practices of unaccredited agents is a major shift in enforcement strategy, moving beyond just individual tax returns to targeting the entire ecosystem that facilitates potentially fraudulent wealth acquisition. The sheer volume of transactions involving these unregulated entities has grown exponentially, making the veteran community a statistically significant area of interest for compliance officers looking for systemic abuse. It's a massive data point indicating potential unreported income streams or highly questionable financial maneuvers designed to mask taxable gains. Consider the complexity of the consulting fee arrangement. If a veteran receives a lump sum retroactive payment from the VA and immediately pays a substantial portion to the facilitator, the IRS is looking at the veteran's overall cash flow. They are asking, how was this expense categorized? Was the veteran advised to deduct this fee as a business expense, potentially creating a fictitious loss? If the veteran reports no business activity, the deduction is invalid, triggering an audit focused on improper Schedule A deductions or worse, Schedule C phantom businesses. This initial focus on the facilitators is the key to understanding the current environment. The IRS isn't primarily hunting the veteran. They are dismantling the network, and the veterans are simply collateral data points in that larger effort. This investigative approach is crucial because it allows the IRS to target large groups simultaneously, maximizing enforcement efficiency. Moving on, the second crucial factor drawing IRS attention is the misreporting and misunderstanding of non-taxable income. While VA disability compensation is indeed non-taxable, veterans often mix this protected income with other streams that are taxable, leading to common yet serious reporting errors. This is where technical complexity meets genuine confusion. Many veterans receive multiple forms of military-related pay. For example, a veteran might receive combat-related special compensation, CRSC, and concurrent retirement and disability pay, CRDP. The rules governing the taxability of these parallel pay systems are notoriously complex, even for seasoned accountants. CRSC is tax-free, but portions of CRDP might be taxable depending on the specific offset calculations. If a veteran or their preparer incorrectly codes the taxable portion of their retirement pay as non-taxable disability income, the discrepancy between the amount the veteran reports and the amount the Department of Defense, DoD, reports via forms, like the 1099R, becomes an instant, unavoidable audit trigger. The IRS receives millions of informational returns, W-2s, 1099s, K-1s, and their primary job is to match these documents to the income reported on your 1040. If the DoD tells the IRS you received $40,000 in taxable retirement pay, but you only report $20,000 because you mistakenly assumed the entire amount was covered by your VA rating, the IRS computer system flags that missing $20,000 discrepancy immediately. This is one of the most common reasons veterans receive CP 2000 notices, under-reporter inquiries. Furthermore, many veterans fail to properly distinguish between their VA benefits and income derived from investment activities. If a veteran sells stocks, real estate, or cryptocurrency, the resulting capital gains are absolutely taxable, regardless of their disability status or whether they use their tax-free VA income to fund the investment. A veteran might mistakenly believe, since all my money comes from my VA check, any profit I make with that money must also be tax-free. This is fundamentally incorrect. The source of the principal doesn't dictate the tax status of the gain. The IRS is seeing veterans with significant investment portfolios, often managed in brokerage accounts that issue 1099-B forms, who fail to report capital gains or dividends, assuming their protected status shields them entirely. The brokerage firm reports the gain, the veteran omits it. Another immediate mismatch. The sheer volume of wealth generated by investment activity in the veteran community, especially during recent market booms, means the IRS is finding more and more high-value discrepancies stemming from this confusion. This issue extends to things like rental income. If a veteran uses their VA loan benefit to purchase a multi-unit property and collects rent, that rental income is taxable income, subject to all standard deductions and depreciation rules. If they fail to file Schedule E to report this activity, the IRS, having access to property records and potentially bank deposit data, will identify this unreported income stream. The complexity here lies in the commingling of funds. When tax-free money is used to generate taxable income, the reporting requirements become stringent, and any failure to meticulously separate and report the taxable components is a direct invitation for an audit. The IRS is highly focused on these specific types of omissions because they are easy to detect via automated matching programs and often involve substantial sums of money, making them efficient targets for compliance efforts. We must emphasize that the IRS is not challenging the tax-free status of the disability income itself, but rather the failure to report the entirely separate taxable income generated alongside or from that tax-free foundation. The third area of intense focus, and one that carries significant legal weight, is the nexus of business income and high disability ratings. This is perhaps the most sensitive area of scrutiny. When a veteran is rated 100% P&T, permanent and total, they are essentially deemed unable to maintain substantially gainful employment due to their service-connected conditions. While the IRS does not enforce VA disability rules, they are two separate agencies. A veteran who claims 100% P&T and simultaneously reports substantial active business income on a Schedule C or K, one raises a colossal behavioral flag. The IRS algorithms are designed to detect inconsistencies between reported financial capacity and claimed physical or mental limitations. For instance, if a veteran reports $150,000 in net self-employment income from an active consulting business, but their primary source of income is supposedly compensation for conditions that prevent them from working, the IRS is prompted to investigate the source and nature of that business income. They are not auditing the disability rating, they are auditing the income. They want to know, is this income truly earned? Is it properly categorized? And perhaps most importantly, is this business activity being used to mask personal expenses as business deductions? The IRS often sees veterans who start businesses, e-commerce, real estate flipping, or consulting, and then claim aggressive, sometimes questionable, deductions that result in a reported net loss, effectively reducing their overall taxable income to zero or even negative figures. If the veteran is funding a lavish lifestyle entirely through tax-free VA benefits and then using a business to generate large artificial losses, the IRS views this as a high-stakes tax avoidance scheme. The conflict here is purely statistical and behavioral. A successful active business operation is statistically unlikely for someone deemed permanently and totally disabled. This statistical anomaly pushes the file to the top of the audit queue. Moreover, the IRS is specifically looking at how veterans compensate themselves from their businesses. If a veteran owns an S-corp but only takes distributions, which are often taxed at a lower rate, or potentially avoids self-employment tax and avoids taking a reasonable salary, the IRS will challenge this structure. They argue that if the veteran is capable of performing the high-level work required to generate six-figure profits, they must take a reasonable compensation salary, which is subject to payroll taxes. This reasonable compensation debate is a major audit focus across the board, but it becomes intensified when the individual simultaneously claims total disability. The IRS is using the veteran's own financial reporting against them, not to challenge their disability status with the VA, but to ensure they are paying the correct tax rate on the income they are clearly capable of generating. This includes scrutinizing expense deductions. Did the veteran deduct a luxury vehicle as a 100% business expense while claiming they are too physically impaired to drive regularly? Did they deduct extensive travel and entertainment? These aggressive deductions, when paired with a high disability rating, signal to the IRS that the veteran might be engaging in overly aggressive tax minimization strategies, justifying a full-scale examination of their business records and personal expenditures. The complexity of running a business while maintaining a high disability status requires immaculate record-keeping and conservative tax filing, and the failure to do so is creating a massive audit magnet. The fourth major shift, which is less about veteran behavior and more about government modernization, is increased data sharing between federal agencies. For decades, the VA, the Social Security Administration, SSA, and the IRS operated in separate silos, making cross-referencing difficult and time-consuming. That era is over. Driven by mandates to increase government efficiency and combat fraud, these agencies now share data with unprecedented speed and precision. The IRS has access to sophisticated software that can pull and analyze data points from the SSA regarding Social Security Disability Income, or SSDI, and, increasingly, from the VA regarding disability ratings and dependent status. This interconnectedness allows the IRS's automated systems, specifically the discriminant function DIF score algorithm, to detect subtle but critical inconsistencies. For example, if a veteran is receiving SSDI, the SSA reports that information to the IRS. If the veteran also claims dependents for the Earned Income Tax Credit, EITC, or the Child Tax Credit, the IRS can now cross-reference those dependents against the VA's records, the SSA's records, and even state databases. If a dependent is claimed by multiple parties, or if the dependent status is inconsistent across agencies, an audit is triggered. More critically, the IRS is using this shared data to validate the capacity of the taxpayer, particularly concerning high-risk credit claims. If a veteran is receiving certain low-income or means-tested benefits from the SSA, but their reported taxable income to the IRS is significantly higher than the SSA's records suggest, or vice versa, the system flags the inconsistency. This isn't just about income, it's about reported status. If the veteran claims they are incapable of working to the SSA, but their tax return shows substantial self-employment income, that discrepancy, while not a direct tax violation, is a behavioral indicator that significantly increases the DIF score, pushing the return into manual review. The technological ability to instantly cross-check addresses, bank account information used for direct deposits, reported marital status, and dependent claims across the three major financial agencies, VA, SSA, IRS, means that errors or deliberate omissions that would have gone unnoticed 10 years ago are now instantly visible. This technological leap has made the environment far more unforgiving. Veterans must realize that when they update their address with the VA, the IRS often knows within days. When they change their bank account for SSDI deposits, that information is integrated into the federal financial profile. This seamless flow of data means there is virtually no place to hide financial inconsistencies, making meticulous and accurate reporting across all agencies absolutely vital. The IRS is leveraging this technology to perform virtual audits before the veteran even receives a letter, identifying patterns of potential fraud or gross negligence based purely on data matching. This is not a personal vendetta against veterans. It is a highly efficient enforcement strategy targeting the statistically riskiest returns identified by government supercomputers. The fifth reason for the increased focus is directly tied to enforcement efforts, targeting ghost preparers and organized fraud rings. The IRS is not just auditing individual veterans. They are engaging in large-scale investigations aimed at dismantling organized tax fraud operations. Historically, tax fraud rings have targeted vulnerable populations, and unfortunately, the veteran community has become a prime target due to the complexity of their benefits and the presence of tax-free income. Ghost preparers are individuals who prepare tax returns for a fee, but refuse to sign the return or include their Preparer Tax Identification Number, PTIN. They often operate in cash, promise massive refunds, and disappear after filing. These preparers frequently target veterans by promising to leverage their disability status to claim credits they don't qualify for, such as the Earned Income Tax Credit, EITC, at maximum levels, or by fabricating large, fictitious business losses. Schedule C fraud, to wipe out any taxable income the veteran might have. When the IRS catches a ghost preparer and they are investing heavily in this area, they immediately flag every single return filed by that individual. This means thousands of veterans who use that preparer, even if they were unaware of the fraud, are automatically subjected to a compliance review or a full audit. The IRS sees the preparer as the source of the systemic error, and the client list is simply the evidence pool. Furthermore, the IRS is tracking fraud rings that specifically advise veterans on how to structure their finances to maximize refunds illegally. This can include schemes involving inflating medical deductions, claiming non-existent charitable contributions, or manipulating the definitions of qualifying children for tax benefits. The common thread is that these schemes often rely on the veteran having minimal reported taxable income, which makes the fraudulently claimed credits, which are often refundable, look disproportionately large compared to their reported earnings. This massive refund disparity is a major red flag for the IRS's fraud detection units. The veteran might believe they are getting a great deal, but they are unknowingly participating in a criminal enterprise's scheme. When the IRS identifies one of these rings, they issue mass audit notices to the affected clients, often demanding the repayment of the fraudulently claimed refunds, plus steep penalties and interest. The veteran is held liable for the contents of their return, regardless of who prepared it. This focus on preparer fraud is critical because it explains why so many veterans who have done nothing wrong, save for choosing a bad preparer, are suddenly receiving audit letters. The IRS is trying to clean up the ecosystem of tax preparation that preys on complex financial situations, and the veteran population is unfortunately caught in the crossfire of this necessary enforcement action. This systemic approach is yielding high returns for the IRS in terms of identified fraud and recovered revenue, ensuring that the scrutiny on this population will continue for the foreseeable future. Reason number 6 centers on a specific area of tax law that interacts poorly with disability income. The misuse and misunderstanding of tax credits, especially the EITC and health care subsidies, the earned income. Tax credit, EITC, is a IRS refundable credit designed to help low to moderate income working individuals and families. It is one of the most complex areas of the tax code and is plagued by high rates of improper payments. For disabled veterans, the intersection of EITC rules and their VA benefits creates a unique trap. Since VA disability compensation is not considered earned income, it generally does not qualify a veteran for the EITC. However, if a veteran has a small amount of earned income, say from a part-time job or a small business, and also receives substantial non-taxable VA benefits, the IRS's system struggles to reconcile these figures, especially when the veteran claims the maximum EITC. The IRS is focusing on veterans who report just enough earned income to qualify for the EITC, but whose overall financial profile, supported by their tax-free VA benefits, suggests they are not truly struggling financially in the way the credit is intended to support. The discrepancy arises when preparers or veterans mistakenly include the non-taxable VA benefits in the calculation of earned income, or when they fraudulently inflate small business income, Schedule C, to meet the EITC threshold. The IRS's automated system is now highly attuned to these threshold manipulations. If a veteran's reported earned income sits exactly at the sweet spot for maximum EITC, but their overall financial stability, based on data sharing discussed earlier, seems inconsistent, the return is flagged for review. Furthermore, the Affordable Care Act ACA premium tax credits, PTC, are means tested based on household income. Veterans who rely heavily on tax-free VA benefits often qualify for substantial PTCS because their reported modified adjusted gross income MAGI is low. However, if that veteran is also receiving certain non-taxable benefits that must be included in the MAGI calculation for healthcare subsidy purposes but fails to include them, they receive overly large subsidies. When they reconcile their health insurance coverage at tax time, Form 8962, the IRS often finds that the veteran received far more in advance premium tax credits than they were entitled to, leading to massive tax liabilities and clawbacks. This is a common, often accidental error that results in an immediate and often painful interaction with the IRS. The IRS is increasingly auditing these PTC claims, especially in populations with complex income mixes like disabled veterans. The sheer volume of veterans participating in the ACA marketplace and the inherent confusion surrounding which non-taxable income streams must be included for subsidy calculations has made this a high-priority compliance area. The IRS is essentially ensuring that veterans are not leveraging the tax-free status of their VA benefits to fraudulently maximize refundable tax credits and health subsidies designed for individuals with genuinely low total economic resources. Finally, the seventh reason the IRS is paying closer attention is perhaps the most visible and easiest to detect: the unexpected audit trigger, or lifestyle creep and visible wealth signals. The IRS uses sophisticated algorithms and public data sources to compare a taxpayer's reported income with their visible economic reality. If a disabled veteran reports $0 in taxable income, relying solely on tax-free VA benefits, but then purchases a $400,000 boat, a fleet of luxury vehicles, or multiple investment properties with cash, that massive discrepancy triggers an inquiry, known colloquially as a lifestyle audit. The IRS is not concerned about how the veteran spends their money, but they are intensely interested in the source of the funds used for these large, unscheduled expenditures. If the reported income cannot logically support the visible wealth, the IRS assumes the difference must be derived from unreported taxable sources. This investigation is often triggered by third-party reporting. Mortgage companies report interest paid, Form 1098. Real estate transactions are often reported via Form 1099-S. Large cash transactions are often flagged under anti-money laundering regulations. When the IRS sees a Form 1099-S indicating a veteran sold a property for a large profit but finds no corresponding capital gains reporting on the veteran's tax return, that is an immediate audit trigger. The IRS is also increasingly sophisticated in tracking less traditional forms of wealth. This includes large cryptocurrency holdings, international bank accounts, and substantial cash deposits that trigger Bank Secrecy Act (BSA) reporting requirements. If a veteran is engaging in high-volume trading or receiving large deposits that are not clearly documented as VA benefits, the IRS will assume these funds are taxable income until proven otherwise. The key takeaway here is that tax-free VA benefits, while substantial, are not meant to fund a lifestyle that dramatically exceeds the income bracket suggested by the veteran's reported taxable income. When the lifestyle dramatically outpaces the reported tax filings, the IRS views it as prima facie evidence of unreported income, whether that income comes from an undisclosed side business, unreported capital gains, or participation in an illicit financial scheme. This scrutiny is a necessary part of maintaining the integrity of the tax system, but for veterans, it means they must be prepared to meticulously document the source of all large expenditures, proving that the funds originated from their protected VA benefits or other legitimate, already taxed sources. The visibility of wealth is the final potent trigger that brings the full force of the IRS down upon a seemingly tax-exempt individual. The digital footprint of every major purchase, every loan, and every property record is now instantly accessible and cross-referenced by the IRS, making it impossible to hide significant financial activity behind the shield of tax-free disability. Compensation. In summary, the increased IRS scrutiny on disabled veterans is not an attack on their earned benefits, but rather a necessary response to systemic changes in the financial and enforcement landscape. The IRS is responding to the proliferation of fraudulent facilitators who create messy paper trails. They are correcting widespread errors caused by the confusion between taxable and non-taxable income streams. They are scrutinizing the behavioral red flags raised by veterans who claim total disability while reporting significant active business income. They are leveraging powerful new data-sharing agreements between federal agencies. They are actively dismantling organized fraud rings that prey on veterans. They are addressing the massive improper payments associated with complex tax credits like the EITC and healthcare subsidies. And finally, they are investigating the visible discrepancies between reported low income and high value, unexplained wealth acquisition. For every disabled veteran, the path forward is clear. Meticulous record-keeping is paramount. You must separate your tax-free VA funds from your taxable income streams. You must choose accredited, ethical tax professionals who understand the nuances of military benefits. And you must ensure that your reported lifestyle aligns logically with your reported income, or be prepared to document the tax-free source of any major expenditure. The protection afforded to VA disability compensation is sacred, but that protection does not extend to the taxable income generated around it. Understanding these 7 areas of intense IRS focus is the only way to safeguard your financial future and ensure that the letter you receive from the government is one of gratitude, not one demanding repayment. The complexity of modern finance demands vigilance, and for disabled veterans, that vigilance is now the frontline defense against the automated, powerful gaze of the IRS.